CNBC-TV18.
Making India ready for emerging challenges amid the evolving global environment. So the challenges are coming amid a global environment, but not necessarily only because of the global environment. I'll try to discuss some domestic challenges as well. But we have to first discuss making India ready for the global challenges. And let me start. I don't want to introduce the guests because they're all so very well known. And Pavitra has already introduced them. We will start by trying to look at what challenges are being thrown by the global environment, and then, time permitting, look at some domestic challenges as well. Let me start actually from the extreme right. Sajjid, what do you see as the global environment? On the one hand, as Pavitra read out, the IMF is painting a picture of global growth, which is likely to be, half the pace it was this year. Probably, from 6.2 to 3.2 to 2.7 next year is the kind of growth pace. So, do you see it as a year of slowdown, or do you see it as a soft landing plus inflation? Please detail.
Thank you, Latha. It's great to be here, and thank you to SBI and to Soumya for inviting me. This is, I think, the question, right? That are we in an environment where we're looking at a slowdown, or are we looking at something more disruptive? Is a more disruptive break imminent? At the start of this year, Latha, the whole discussion was on reflation before the war. By June, it became recession. I would argue by November and December, we have to use the word resilience. And why do I say that? Think of what we've gone through in 2022. You've seen, the strongest global inflation, especially in advanced economies, in 50 years. This is the most synchronized and coordinated and aggressive tightening cycle in 40 years globally. We've seen the strongest dollar in 20 years. And what's less appreciated is we've seen China's growth will be the weakest this year since 1976, barring the pandemic year. In a normal year, two of these shocks would tip the global economy into recession. We've had 4 shocks simultaneously, and guess what? Global growth is on course to print at 3% this year. So first, let's acknowledge how resilient the global economy and emerging markets have been in 2022. Why is that? Because this shock was always different. As we've discussed before, especially in the US, private sector balance sheets have been very resilient. US households began with excess saving of almost 3 trillion. Corporate balance sheets in very good shape. So the private sector, unlike previous crises, has had plenty of firepower to withstand the shocks. Now, normally I'd put the mic down and say this is very good news. But in this crazy world we live in, where good news is bad news and bad news is good news, this is not really good news, because what it means is that if there's no recession that's imminent, and we at JP Morgan don't think there's a recession coming in the next 6 months, it means the chances of inflation going back to central bank targets around the world is lower, which means central banks around the world have got more work to do. I'll end with 2 thoughts. Focus very much on labor markets in the US. On labor market. This is the tightest labor market in 50 years. You're looking at wage growth at about 5 to 6%. US inflation of 2% is incompatible with wages at 6%, especially where productivity is slowing, which means, unfortunately, the Fed will have to slow the labor market, push unemployment up, push wages down, and only then will it have the confidence to bring inflation at 2%. In other words, Fed rates are going up, and they're going to stay high for long. And my first worry is the world has never seen 5% US interest rates in 25 years. We've all grown up with 20 years of free money, 0 interest rates, a Fed put. So the question is something going to break next year? Right? At 5% interest rates, is something around the world that we don't fully understand going to break? We saw a small preview of this in the pension fund. We saw this in crypto last week. So I'll end by saying, right now the good news is there's no recession. The sobering news is central banks will have to do more to bring inflation down, and in this higher for longer world, is something going to break? Will we have a harder landing later on because growth is not slowing enough right now to disinflate?
So, in short, next year, are you expecting that a soft landing is impossible, that we're going to have more than 5% Fed rate, or you think it's at 5 but stays still 5 throughout the year? exactly what should we prepare for?
So JP Morgan's baseline, like everybody else's, is agnostic because there's too much uncertainty. Our baseline currently has Fed rates at 5% and then they stop sometime in March. We have a situation where, as you said, global growth halves from 3% this year to 1.5% next year. But we have a quite benign situation where the US only goes into recession later in the year, and it's a shallow recession like the kind that Europe is having. If we can get through that year, that would be relatively benign in my view.
Okay. Ashima, would you want to add to that? Most importantly, I would want to understand about this inflation part. Are we going to continue to have, if you say that 2% is very difficult immediately, are you preparing for a slightly higher level of global inflation? And what impact might that have on us?
Well, I've been saying that we need to distinguish Indian from US inflation. This tight labor market, we don't have that, which gives persistence to inflation and keeps it high. But I think there are certain features in the global environment that are somewhat positive. One, that their long-term inflation expectations have not gone up that much, and their interest rates now are in the restrictive territory or slightly positive territory with respect to that long-run inflation. So therefore, they might not need to raise much more. And then you are having a global commodity slowdown, so that could bring down inflation faster than we expect. But of course, in the US, because of the huge stimulus and tight labor market, that is going to keep inflation high. And the second positive thing is that the Fed now is not saying that we are going to keep rates high until we reach 2% inflation, which is their target. Because they've recognized lags, that, you make it to some, when it comes down to 4, maybe you can stop and wait for further action. And then when we come to the Indian case, we have a lot of advantage. Can I come to the Indian case now? So I think I like to put it as double diversity. That is advantage for India, because we have a very diverse economy. So for example, recently now exports have gone down, but software exports are doing very well. We're seeing remittances go up and so on. Agriculture was down the last year, but it's looking like it might turn around. Domestic diversity. And then global, because the diversification from China, we're a very small part of exports. So even if we encourage the government schemes, PLI and so on delivers, already it is, because electronics exports are still doing well, So that sort of diversity is going to help India. And then finally, as we look at those pluri-shocks, as Anant was saying, we know that we've dealt with extreme, unexpected pandemic once in 100 years, and then a war, which seems interminable. So we have dealt with this and we are doing relatively better. So we know that we can handle. There is some resilience in the economy. And I think this comes from our monetary and fiscal policy, and as well as structural reform, being sensitive to the Indian conditions. Like here we had those food grain stocks, we provided security, and at the same time, the shifted government spending towards infrastructure and other logistics, etc., to bring down costs. So very good monetary fiscal coordination. Monetary policy provided support, but time barred, so in line with reforms. It does not create poor incentives. It was withdrawn. The take-up of structuring is very little. We had the fastest turnaround, where you are rebalancing liquidity, because if rates are high, you have to bring liquidity down before you can raise repo rates. Yeah. Okay. So we have all these positives. And the last thing I must mention since I'm here, is that our financial sector is very strong. We went through 10 years of reform, restructuring. That is really substantial changes. And so we are in a position to have slightly softer monetary financial conditions. The interest rate has gone up to recover from the pandemic lows, but it's not that high. And it is sufficient to allow activity to recover, while the real rate is positive, so that we are inflation targeting, so inflation expectations continue to be anchored.
Okay. Well, thank you for that domestic bit as well, but I want to persist with the global environment with the other experts as well, and then come back to the domestic analysis. Rajeswari, people paint a picture of extreme global recession. That's one scenario that's painted. The other scenario is that it will be a soft landing. And which way do you lean?
Thank you so much, Latha. My first instinct was to say, am I audible? Because after 2 years of being behind the screen, that's the sentence that I got used to. And I must, before I say anything, I must thank SBI for inviting me. It's wonderful to be in person along with so many people in the same room. So just focusing only on the external sector for now, I think let's look at it from two different angles. One is there's the US story and one is the European Union story. On the US, I think the situation is relatively unclear. Because on one hand, the Fed is indeed embarking on the fastest pace of monetary tightening in the history, something that we have not seen. Yet on the other hand, and sort of following up on what Sajjid said, I think there are three factors which are working in the favor of the US economy. One is that the households are sitting on a lot of savings, primarily because they received huge transfers during the pandemic, much of which got saved. Secondly, the real interest rate in the US is still negative. The Fed funds rate is around 3.7 to 4%. The PC inflation is 6.2%. So they still have a real negative interest rate. And unemployment is still quite low at 3.5, 3.7%, despite the fastest pace of monetary policy tightening. And the third point is the labor market is unusually tight, right? So for the longest of time in the US, the job vacancies exceeded the number of unemployed. Even now, there is that gap that persists. This can go one of two ways. One is the firms get desperate. They realize that they have to increase wages, and they do that. The incomes go up, employment goes up, but at the same time, inflation goes up too. Or the firms realize that they cannot hire anymore because demand is going to slow down very soon. They give up, wages fall, incomes fall, but then unemployment goes up and we have a situation of recession. I don't think we're in a situation today to be able to predict which way that is going to go. Okay. So I'm going to say that the US situation is relatively unclear. But I do agree that I think after 5% the Fed is going to hold. And I think this Fed is relatively dovish in the sense that at the first signs of unemployment going up, they may even start considering discussions about when do you start unwinding the tightening policy, so to speak. So it's very difficult to say what's going to happen next year. Now, what I want to focus on is, more than the US, I'm particularly worried about what's happening in the EU. Because I think the European Union is definitely headed towards a recession. Because unlike the US, they are dependent on Russia for natural gas. They are facing an energy crisis. They are facing an adverse terms of trade shock, which has sapped income. The industrial base has gotten very badly disrupted because production has gotten expensive. And you see the inflation rates in EU. I mean, EU has 10%, UK has 11%, is exorbitantly high levels of inflation. They haven't even started the kind of monetary tightening that the Fed is doing. They're lagging behind. So I would say, for emerging market perspective, much of the risk lies in the European Union, to the extent whichever EM is exposed to the EU definitely runs the risk of a lot of volatility. And there are also financial stability concerns in the European Union. So in the US, despite a 3% increase of interest rate, the financial system has been extremely resilient. Because after the 2008 crisis, the US financial system got much more conservative. We are not seeing any kind of financial sector blow up. But in the European Union, there are financial stability concerns in UK, in Italy. So that, to me, would be the main area of concern. And again, China is the uncertain part in all of this as well, because we recently know China is really struggling to deal with COVID despite the zero COVID policy. So again, whichever EM, whichever country is exposed to China will end up facing that heat as well. So I'm going to stop here with the external sector and just stop by saying we are facing radical uncertainty of a kind that we have not seen during our lifetime. And any kind of forecasting, be it GDP growth, be it inflation, it has become that much difficult.
A long